Hello and welcome to your latest Asset Intelligence Market Update. Now, at this point in the year, it's probably fair to say that our best intentions for New Year's resolutions may have started to wane a little. Perhaps those promised trips to the gym have started to become less frequent, or maybe the siren song of the fridge freezer seems louder now than it did at the start of January. Yet one entity seemingly sticking to its pledge to do better this year is the stock market. In the wake of a 2022 which was very challenging for the most part, the global share index returned almost 7% through January and the first half of February. What lies behind investors' sudden outbreak of optimism? We can look to the emergence of three key factors to explain the gains. First up, that word again, inflation. The issue of rising prices dominated the conversation on the economy last year. A combination of supply chains damaged by COVID, labour shortages and the energy fallout of the war in Ukraine contributed to pushing the cost of living up significantly. Central banks, like the Bank of England, responded by raising interest rates sharply, the aim being to cool consumer demand and business investment down by making it more expensive to borrow. Yet, in broad terms, higher rates also tend to have the side effect of putting asset prices under pressure. Company profits may take a hit, cash becomes more competitive compared with stocks and bonds, and house prices tend to fall as mortgage rates rise. Recently though, there have been signs in many of the major economies, including our own, that the worst of these price shocks are probably behind us. Annual inflation rates are starting to notch lower, and oil and gas prices are well down from their recent peaks. In turn, investors are hopeful that central banks may not need to push interest rates up much more than they already have. Second, there are some indications that the global recession predicted for this year won't be as severe as first thought. Contrary to the Bank of England's own expectations, the UK narrowly avoided recession at the end of 2022, and some forecasters now believe we can repeat the trick this year. Similarly, the Eurozone economy is looking in better shape than anticipated, thanks to those tumbling prices for energy. And here's news that might surprise you. For reasons including efficiency campaigns and a mild winter, natural gas prices are now lower than before the invasion of Ukraine. The US economy is also continuing to display considerable resilience, with recent data on jobs gains and the strength of the services sector massively outperforming expectations. And third and finally, China's rapid about turn at the end of last year from a rigid zero COVID policy to reopening society is seen by investors as a major positive surprise. A revival of demand in the world's second largest economy will help to support the broader global picture. Indeed, recent stimulus from China's central bank has almost certainly fed into positive performance for global markets more broadly. Well, that's all from me this month. Feel free to like, comment, share and subscribe. And whether you've stuck to your guns on your New Year's resolutions or it's all gone a little bit off the rails, take a bit of inspiration from the market and keep making it a great 2023. Thank you for watching.